What's going on, everyone? This is the third Facebook Live that I've made in a row, and that's probably the first time that this has really happened in a few months. I can't remember making three in a row in really a really long time. But again, just had another conversation today that I really wanted to talk about, and that's how we've scaled, I guess, so rapidly from doing 3 or 4 homes a month, and then scaling up to roughly doing 10 a month. Pushing for 100 to 120 homes this year. And not all deals are equal, I think, is my main message here. It's that, initially when you start and you get into real estate, you want to do 1, 2, maybe 3 deals a month. Like, that's going to be your max. And the reason being is because it's very, very difficult to find deals that you could buy theoretically 100% with cash, renovate with cash, refinance, and be able to pull all of your cash back. Because when you're doing more than 3, it starts to become really difficult to find lenders that'll let you refinance with no seasoning period and not looking at your cost basis. And of course, at the beginning too, you don't have a ton of money. You can't just leave funds in deals. You need all that back out. Otherwise, you don't have a business to begin with. So you're constrained on the banks. And then it's just really difficult to just find more than 3, 4 deals like that a month where you're going to be all in, below 70, 75% of LTV, loan to value. And all that means is that, if you buy a property for 50, you put 25 into it between your holding costs, your closing costs, your renovation costs, and that property appraises for 100, it's like, okay, you're all in 75, that's 75% loan to value, LTV. So what's really cool though is once you get, I can't remember the exact number that we got to, but you get to a point where your snowball becomes big enough. And what I mean by that is your cash flow and your reserves. We hold 6 months PITI for everything we own. And it's painful to look at, but it's helped us scale this fast, and it'll make sense here in a second. So setting that money aside, building reserves, not only helps us continue to get banking, because banks don't want to see someone who is doubling, tripling their portfolio every single year. Like, they just don't want to see that at all. They want to see someone buying 1, 2, 3 houses every few months, really good deals. Like, that's stable. Banks love that. They do not like when you're buying, 50 homes one year and the next year you buy 100. Like, they hate that. But the one way to offset that is just have ample reserves. So you have to make sure, you're doing your 3 or 4 deals a month where you're able to cash out fully, pull all of your money. Not only do you now own that property for free, but you're walking with $10, $15, $20, $30,000 from that property that's going to build that 6 months PITI. And here's the kicker. You don't pay yourself with that. Okay, because six months PITI when you're scaling this fast is not enough. Like, that's our minimum that we hold for, again, everything that we own. But so once you have that, banks will let you start pushing the envelope a little bit more, where you can really start pushing 80%, maybe even 85% loan to value. And not every bank will refinance. In fact, most won't above 80%. It's getting actually really right now extremely difficult to find a bank that'll refinance at 80%. In fact, most banks, especially if you're not looking past the seasoning period, they're going to want you to be at 70 or 75%. So with that being said, you're snowballed because you spent the last year or 2 years doing 3 or 4 deals a month that are really, really good. You can now afford to do another 2 or 3 a month that, let's say, are break even, where you're not able to pull a ton of cash out, where you're not walking with, again, the $10, $15, $20, $30,000. So I think my point with that is it gets to a point where you have enough reserves that you're just a high income earner and you have to spend your money. Okay, so what are you going to invest it in? Are you going to invest it in the stock market or in crypto? Or are you just going to double down on real estate and keep buying deals as long as you have ample reserves and have those reserve numbers where the bank's going to let you continue to grow? And so I feel like I became really comfortable with that when we passed probably the 150 unit mark. Became comfortable with, hey, if I leave a little bit of money in some of these deals, that's okay. Like, I need something to do with my money. Like, I'm just a high income earner now. Like, I need to deploy it. If it's a good house in a good area and I've replaced all the mechanical systems and I think it's going to make money as a rental or a lease option, I'm okay if I can't cash out and pull every single dollar I have out. And then kind of progressing further, whenever you get past I'll say the 250 mark, It's like now your snowball is so big that you are a very high income earner and you have to spend your money. I mean, I don't know what the inflation rate is now, but sitting money, like it's not making money. So that allows you to, again, you're not paying yourself this, you're like doubling down every single year. Otherwise, banks are not going to lend to you. Like they do not want to see that you're, doubling, tripling your portfolio every year, doubling in size. You're not putting any money away. So you've stashed some money away. Like you've proven that you're not just going to go out and be reckless and buy something stupid. You're going to build your reserves. And now you're at a point where, again, you have to spend your money. So 3 or 4 super, super good deals a month. Another 3 or 4 that are, 80%. You might leave $1,000 in, they might be break even. And then the really cool part is when that snowball becomes big enough, you're just buying things that you want to own. Again, if it's going to make money as a rental, if it's in a good area, and if during the renovation you had to replace all the mechanical systems anyway, that's something that's worth owning, especially if it's in Union, Bixby, Jinx, Broken Arrow, or a really good school district, really good area. So that's how we've scaled. I know that it's super tempting to want to jump from 0 to 10 overnight, but you have to remember we've been working on this for 2.5 years. I feel like that's an extremely rapid pace of growth, but that has been our progression. You can't just go like 2.5 years ago, there had been no way that we could do 10 a month because we didn't have the reserves to support it. And then again, it's really, really tough to find, more than 3 or 4 deals a month that kind of fit and check that box where you're pulling a ton of cash out. So that's how we've scaled. But I think the main point is when the snowball becomes big enough that you're just a high income earner, you can put more money down, you can leave money in deals, you don't need all of it back out. That helps you grow. Don't buy something stupid on your first big cash out refinance. Double down on everything and just pay yourself off the cash flow. I'm going to repeat that. Do not ever, ever pay yourself off a refinance. Use that money and pour it back in to buy more things. Pay yourself off the cash flow. And banks will love to see that. They'll continue to lend with you. And when you get to a certain size, they start doing something creative just for you. The president starts calling you and wanting to work with you and in a way begging you to move your reserves over because, again, 6 months PITI on 350 units, like you can do the math on that. So people would then come to you wanting you to move your operating account over, and they're giving you really good terms because they want your business, and it's kind of flipped at that point. But again, if you're going out and buying something stupid, you're not going to have that. You're just going to be done. So and stuck at 3 deals a month, and that's assuming that you have continued to put away money for the marketing. So thanks everybody for watching. I had this conversation earlier and just wanted to share. It's kind of the natural progression of scale. I think the one caveat to this is if you took on a money partner early, you could probably scale up faster. But I don't know. I've chosen not to do that. We've taken some investors, like as far as like syndication on the multifamily stuff, but never on single family. I don't want to. I don't ever plan to. If it's not good enough that I can invest my own money or get hard money for it, I'm just not going to do it. So thanks everybody for watching, and who knows, maybe we'll continue the streak tomorrow.